Progress. Good morning. Let's head to our seats. We're going to get going here in just a second. Tina. Well, good morning, everybody. Thanks for coming to the first in-person meeting of the North County Estate Planning Council San Diego. How many people are sick of Zoom presentations? But we certainly appreciate your coming, and as I've talked to you all over the last year and a half or so, it's the first question is always, well, when are we getting back together? But it seems like we're getting there, so happy to have everybody here. We have a couple other firsts that are going on. The fellow up here is Ron Aucutt, who I'll give an introduction to just shortly. But so this is our first remote speaker coming in. And then we're also set up for Zoom for anybody that couldn't make it to this meeting. So that's kind of another new thing. But and then we also have the new venue here at Loma Santa Fe Country Club. Just one heads up, just right off the bat, on October 28th, from 4 o'clock till 7:30 or so, we're having a social event, which will be right outside here. Beautiful spot. Let's see. Yeah, so we'll be able to watch the sun go down. And even right now, the sun coming up is a beautiful spot here. Certainly, we have a number of different things going on with today's meeting. We have our sponsor, who I'm going to turn over to David Jacobs and Scott Hinkle right now. And come on up and do your thing.
Thanks, Bill. Hey, everyone. Wow, it is so great to see everybody in person. This is just terrific. Even you people on Zoom, it's really nice to see you guys in person too. And I hope that everybody on Zoom will have the opportunity to come back in person. If you were here, you would know that this room is crowded and everybody is smiling and happy to be in person. So we encourage the balance to go from Zoom to in person like this in the future. So welcome, everybody. Thanks for allowing us to sponsor this morning, Bill. My name is David Jacobs. This is my partner, Scott Hinkle. We are principals at the firm Acumen Insurance Solutions. We provide life insurance solutions to family businesses, to privately held individuals and families, nonprofits and credit unions. We're going to go over really quickly some of the areas in which we practice, some of the uses for insurance and estate and business succession planning, and some unique features that our firm offers that we find that others in our industry don't. So maybe if you can quickly go through the slide real fast here, Brandon, where are we here? Oh, terrific. Great. Well, let me really start by just introducing who we are. As I mentioned, I'm David Jacobs, my partner, Scott Hinkle. We actually have 3 offices, one here in Del Mar, one in North Carolina, as well as one in Arizona. All we do is life insurance work, and our firm has pioneered some of the institutional designs that you see in the life insurance world today. All of our principals hold advanced degrees. Scott and I are both JDs. Scott's also a CFP, but we don't manage money and we don't practice law. We just do life insurance work. What we really want to be is a resource to everybody in this room. We know life insurance is complicated. It can be confusing. It can be opaque. And we want to serve as a resource to the folks in this room and on Zoom that if you have any questions that you or your clients are running into that involve life insurance, please pick up the phone, give us a call, shoot us an email. We're happy to help and serve as a resource to you. I'm going to turn it over to Scott for just a second, who's going to describe a little bit about the areas in which we practice. Yeah, it's a little hard because we can't see the slides, but that's all right.
In fact, I can't even see the slide. We'll just go from memory and see how we do. So as Dave mentioned, we do all of the traditional insurance work that you're probably all familiar with. We don't do anything else. So we're not going to try to manage money, do other lines of insurance. We don't practice as accountants or attorneys. So as it relates to families, typically it's estate planning work. Businesses, it's by self-funding, it's non-qualified deferred compensation arrangements. And then we have some uniqueness as it relates to nonprofits, which we have an extensive client list, predominantly in the credit union space, but also education, medical, and the like, where we've developed some unique deferred compensation arrangements or executive compensation structures. But then we've also developed a program that has been very successful with these particular institutions. At the end of the day, if any of you are familiar with BOLI, which is a form of life insurance specific to commercial banks, the idea here is that these institutions tend to be very conservative. They tend to retain a lot of liquidity. And in today's world, chasing yield is just not acceptable. They're not going to extend duration. They're not going to take excessive credit risk. And so the solution is really simple. Keep it safe, keep it liquid, earn more than what you're earning today. And along for the ride comes death benefit. So that death benefit can be used for a number of different purposes, depending upon the clientele. And so at the end of the day, we serve those people that want to be served. It's just there's a lot of liquidity in the system. Yields are extremely low, historically low. And so this has been a very well-received platform. And I think that kind of flips the life insurance conversation upside down. If you think about it, your clients that own life insurance or have been purchasers of life insurance, they sort of view it as a black hole. Money goes into this bucket. I'm never going to get it back. The only people that get it back are those that are named as beneficiaries. This is the exact opposite. This is literally, I put money into a bucket. I can get it back within a week. I can't lose money. And if I happen to own it by the time I pass away, then my beneficiaries get a multiple of my investment. So that's been a very topical value proposition we've had a lot of success with, I'd say, over the last couple of years. And it's something unique that no one else is doing. So keep an eye out, obviously, for people who have a lot of liquidity, whether it's individual, business, or institutional, because we did definitely have a unique value proposition there. But as Dave mentioned, we have offices in several parts of the country. I would expect that footprint to expand over time. And we just want to serve those that need advice. At the end of the day, I think philosophically, we're not shoving square pegs into round holes. It's be reasonable, do what's right for the client. We've been here a long time, and the last thing we want to do is tarnish our reputation. So if we can help, please let us know. Otherwise, we appreciate you all spending a little time with us today and us getting to know you a little better. Well, you all know Dave, but they don't let me out of the closet very often. So today's a special day for me.
Get back in the closet.
Get back in there.
Yeah, thanks, God. Thanks, everyone, for your time. We really want to thank the North County Estate Planning Council for being here, for providing education for the public at large, and being a great forum for professionals like this. If we can serve as a resource for you in the life insurance space, it would be our pleasure. And with that, turn it back over to Bill. Thanks again, everybody.
Well, David, Scott, thank you so very much for being the sponsor. Hello, Zoom attendees. I appreciate your being here. And we know certainly with some of the younger parents dealing with things from afar at your home computer makes that a little bit easier, or for some of the folks that live a little further away, don't have to deal with this drive at this early morning hour, but thrilled to have you all. Certainly a couple things to mention about David. Of course, he's on our board with Pete Tentler and Phil Sullivan. Carly Harmonson, who used to be on the board, has retired. And I mean, I think she's really retired, which is, amazing given how much she was everywhere on the West Coast. David really is the person responsible for our website and our LinkedIn presence. So David is the guy. A couple other folks to mention is Brandon Waterton, who's our AV person. He's the real expert, with today's meeting being the first with a remote speaker, Zoom attendees. I had a lot that I was worrying about, David was wondering about, and Brandon's like, I'll quit worrying about it. I do it every day. So a great person to have on our team, and certainly highly recommend him if you need AV help. Chelsea Duff is, I guess she's the events coordinator here at Loma Santa Fe Country Club. She wanted me to just pass on that, you don't have to be a member to use the rooms here. This is one big room, but there's dividing areas that we can come in and deal with smaller groups here. So can't recommend Chelsea enough. She was so welcoming, and as we moved from what was the old place, Fairbanks Ranch. There's a story there, but we're happy to be here at Loma Santa Fe. Thrilled to be here with the social event at the end of October and out here in this beautiful location. I want to bring up Eli Ben, who's with the Jewish Community Foundation. He's going to give just a brief update on a new program that they started there as our nonprofit sponsor. Oli? Oh, there he is. Sorry, I thought that was Jeremy.
We are twins. Thank you so much. It's wonderful to be back in person and not seeing you just on Zoom, although it's great to have the people who are on Zoom as well. My name is Eli Ben. I'm the Director of Philanthropy for the Jewish Community Foundation. As you get into end-of-year tax planning with your clients, we know you have clients who want to do some good for their local communities and lower their tax bills in the process. And we're always very grateful when you advise them to open a donor-advised fund with the Jewish Community Foundation. However, we also know you have clients who want to have an immediate impact with their philanthropy. If a client said to you, homelessness is a big problem in this region, it's out of control, what can I do about it with my philanthropy? How would you actually respond to those clients? Neither they nor you want to spend hours researching this or figuring out what to do. You just want to make a difference. Well, Give4 is our way to make tackling big local issues like homelessness much easier. So Brandon, let's take a look. I'm so glad I'm not the person doing the Zoom transitions right now.
Helping.
Having our money make a difference for San Diego.
Having real impact.
It's not easy to figure out what to do or where to begin.
How can I really make a difference?
Until now, it's been difficult for individuals to make a meaningful difference on big issues like homelessness here in San Diego. That's why we've created Give4, to make it easier to tackle big local challenges with one donation. We've carefully curated 12 nonprofits working to end homelessness in San Diego. Each month, you'll see the impact you've made for a different organization taking on a different aspect of homelessness. We believe in the power of every individual to make a difference, but then when we come together, we can change the world.
Give for yourself.
Give for your community.
Give for the cause you care about.
Give for homelessness in San Diego.
So as we load up the slide deck, some of you may recognize our friends at Rolling Associates who moonlight as volunteer actors at the same time. And we're very grateful for their help. So Give4 is JCF's attempt to provide an easy entry point so that anyone at any giving level can participate in tackling big local issues like homelessness. It's motivated by our goal to engage the current, and do we have the slide deck? Thanks. It's motivated by our goal to engage the current and next generation of clients and donors who care about issues, not institutions, and want giving to a cause to be as simple, just next slide, to be as simple and technology forward in their lives as calling an Uber or sending a Venmo payment. But it's also motivated by our deep desire as a community foundation to support the local nonprofits who are doing incredible work. We at JCF asked ourselves, how can we provide a platform to connect grassroots organizations and donors and to tell the stories of the incredible work of these nonprofits along the way? So next slide. So that's where Give for Homelessness in San Diego was born. We asked homelessness experts from San Diego to curate a fund of 12 nonprofits, each taking on a different aspect of homelessness. We make it super easy so that anyone, not just staff holders, can give to the fund. And then we're creating very shareable 1-minute videos each month telling the story of a different nonprofit from the funds. So here are the 12, so next slide, here are the 12 nonprofits in the fund. There are some names you'll recognize, like Interfaith up here in North County, and others that are probably new to you. Each one has a unique story. Next slide. And you can learn more about our you can learn more on our website, give4.org, where we explain how Give4 works. Next slide. We have a ton of learning resources. Next slide. And many ways to give. So just the next slide is the last one. And I'll just say that we launched Give4 less than 2 months ago. And frankly, we've been blown away by the success. We've already raised over $120,000 in about 2 months, including from some folks in the room and their clients. So thank you very much. And we're just getting going. So if you or your clients are interested in learning more, come chat with me after the presentation, or go to our website. I put our business cards on everyone's table as well for Give4. So let's all of us begin to participate in the solutions to one of our region's biggest problems. Thank you.
Ali, thanks so very much. A very innovative program that you all have put together. And I certainly want to recognize Pete Hintler, one of our board members, but he's the person that's been involved in putting together our trifectas for getting together with 3 or 4 people outside of the meeting space where you can have a coffee, lunch, or breakfast and get to know each other and get that deeper relationship. So now that we're getting back in person, we're going to get that kicked off, and hopefully you all will be able to participate, because nothing better than find out, well, what someone's working on. What school they went to is okay, but what they're working on and what their clients' needs are, that's going to be the thrill of that. Remember, we meet the first Tuesday of every month, so put that on your calendar, 7 to 9 plus. And our November meeting is going to be on deferred compensation for closely held and small business, family businesses. That's going to be led by Corey Grant and a team of attorneys and other professionals that work in that area. Being out of the CPA world, the solution there is life insurance, but it's the whole plan and the reasons behind it is the more fascinating piece. So it certainly is a piece that I'm looking forward to. So thanks, Corey, for helping put that together. Without any really further ado, certainly want to introduce you all to Ron Aucutt, Senior Fiduciary Counsel at Bessemer Trust out of Florida. So our first remote speaker. But Ron, thank you so much for being here for the presentation. Ron is an ACTEC fellow, and in his role as senior counsel at Bessemer Trust, he's responsible for working with clients and their advisors to develop practical and efficient wealth transfer plans. And prior to joining Bessemer, Ron practiced with the law firm Miller Chevalier, chartered in Washington, D.C., and with Mike McGuire Woods, LLP in Tysons, Virginia. He advised clients, lawyers, and other professionals on estate planning and helped resolve tax issues through IRS appeals and beyond. He's a fellow and former president of ACTEC, American College of Trust and Estate Council, and as an officer in the U.S. Navy in the Gulf of Tonkin during the Vietnam War. More importantly, I think of Ron as Mr. DC Watcher. He's, with his time up in the DC area, he developed relationships within not just representatives and senators, but it's the House Ways and Means Committee, the Senate Finance Committee, and the Joint Committee on Taxation. And so Ron is going to share his insights on some of the proposals and other administrative direction that the Biden administration is taking, and giving his insights on, well, what's going to happen or what's not going to happen. So without any further ado, Ron Aucutt.
Thank you very much. I'm really privileged to be able to meet with you even in this virtual way. But it is a good accommodation for some of the challenges that we face. Speaking of challenges, I want to say how much I appreciated that presentation about the Jewish Community Foundation and the fantastic initiatives. That was just very encouraging and heartwarming to hear. Now, I wish that I could tell you that I'm going to continue on such an encouraging and high note, but I've been asked to give a Washington update. Pending and potential administrative and legislative changes. We'll, of course, focus on the legislative. And because it's the most recent, not necessarily the most important, we will begin with the House Ways and Means Committee action. We had on the 12th of September, Chairman Neal of the committee introducing what's called the Chairman's Mark. It's kind of a starting point. There were no changes made by the committee in the areas that we're going to be talking about that concern us, and the committee approved that. It's got a bill number 5376, approval date of September 15th, and then through the Budget Committee and Rules Committee, it has now made its way to the floor of the House, and we'll see what happens. You know, you all want to tell me exactly what's going to happen, and I have no idea. I will give you some guesses, just because I have guesses, even just because I have reasons for those guesses, doesn't make them any more than just guesses, and I want you to know that. But there are challenges in evaluating and predicting what Congress is going to be able to do. There are challenges for Congress itself and its members and its leaders. You remember the bipartisan commitment to the infrastructure bill. It was going to be one of the first things passed last spring. No problem. Then we'll move on maybe to some of the more challenging things. Well, do I need to finish that story? Well, I can't finish the story. I don't know the end of the story, even with the infrastructure provisions, as you know. And if that easy, bipartisan, everybody supports it, provision has been so slow and so difficult and so challenging, what can we say about some of the tax issues that we're going to look at? Here's just a sample of the income tax changes. I don't intend to dwell here or make this the focus, but just to sort of set the table. Top individual rate, income tax rate would go back to 39.6 like it was before 2008, before the 2017 Tax Act, beginning next year. And the rate brackets are going to come down a little bit. So this is an increase in taxes for those in maybe the $400,000 to $600,000 range, and about $13,450 projected by the staff of the Joint Committee on Taxation for trusts and estates next year. Plus a surtax of 3%. That's not 3% of the tax. Surtax is maybe the wrong. It's an additional 3% of modified adjusted gross income over 5 million. And for trusts over 100,000. Now those are big caps. If you look at the 400,000, oh, that kind of tracks to 5 million, like the 13,000 for trusts tracks to 100,000. It's a much bigger number. Modified adjusted gross income means you take adjusted gross income and then wait for it, modify it by subtracting investment interest below the line deductions. That is, deductions that will be taken, but they have not been taken into account above the line in determining AGI. Meanwhile, the capital gains in the 39.6% bracket, the top income tax bracket, will be taxed at 25%, not 39.6, not 28 like it used to be, not 20 like it has been the last few years, but 25, a sort of push-pull compromise, but effective September 14th, meaning that it would be effective today. That's assuming it passed and is effective at all. I want to just mention the revenue estimates. For the next 10 years, The provisions you're looking at on the screen are estimated by the Joint Committee on Taxation staff to raise $421 billion. A couple more miscellaneous income tax things. The trade or business exception for the 3.8% tax on net investment income under Section 1411 that was added early last decade in connection with some of the Affordable Care Act legislation. This is, by the way, estimated to raise $252 billion over the next 10 years to eliminate the trade or business exemption for incomes over $400,000. Again, for trusts, it's going to be over $13,450, meaning that all of that hand-wringing we did over what it means for a trust or a state to materially participate so that it would qualify for this exemption is now pretty much moot, because even if it qualifies, that exemption is going to be eliminated under this proposal. Again, just a proposal. The measurements, $400,000 and $500,000, it's modified adjusted gross income again, but this time a different adjustment. AGI less foreign earned income deductions that are made below the line and not taken into account in determining AGI. For trust and estates, though, it's just simply the 39.6% bracket. Qualified business income deduction, that 199A thing, will be capped at $400,000, $500,000 for joint returns. Again, very modest cap, a very modest availability, only up to $10,000 for trusts and estates, or this business income deduction pretty much disappeared. And this is estimated to raise about $78 billion, mostly in the first 5 years, because the qualified business income deduction is going to sunset in 2026 by its terms anyway. Now, if you've been keeping track, on the last two slides, these miscellaneous income tax changes would raise about $751 billion over 10 years. That's the projection, about $750 billion. And you need to keep that in mind as perspective as we move into some other changes that are proposed. As far as the estate tax is concerned, we were expecting the doubling to sunset in 2026. This bill would propose to just double it early, or sunset the doubling early next year. This is estimated to raise about $54 billion over the next 10 years, as you might expect, mostly in the next 5 years. Now, the topic that so many have been talking about, grantor trusts. Trusts generally, like entities, things generally, partnerships, LLCs and so forth, have a big bullseye on them. And if it is a grantor trust, especially if it has some kind of an acronym or a name, it's got a big orange bullseye on it. The IRS has been going after these, even though it was the IRS that in effect created these. When before we had joint returns available to spouses, it would have been the case that one spouse with a lot of income would create a trust to supposedly share some of this with the spouse before we had joint returns. As I said, and the IRS said, no, you can't do that. If this trust has certain features, then we're going to treat you, the grantor, as the owner, the deemed owner, the owner of the trust, the owner of what's in the trust, the owner of the income of the trust. And so it has played out that we have taken advantage of what are called defective grantor trusts as effective grantor trusts for so much of our estate planning. But a new Chapter 16 proposed by the Ways and Means Committee, consisting of just one section, 2901, would, as it says in the description, align transfer tax treatment with grantor trust treatment. We've seen these proposals before. The value in the trust would be included in the grantor's gross estate. Distributions from the grantor trust, except to the grantor or grantor spouse, are taxable gifts, and termination of grantor trust status is a taxable gift. So there, just aligned. Income tax transfer tax, what's incomplete for one is an incomplete gift for the other. Only, however, if the grantor is the deemed owner. It would not apply if a beneficiary is the deemed owner under Section 678. So what would happen if this passed? Well, basically, the usefulness of grantor trust that I described as kind of a linchpin of our practice would almost entirely disappear. Because the buildup, like grantor paying tax on someone else's income, we know that's what grantor trusts are about. And that allows the grantor trust to build up, fine. When grantor trust ceases or the grantor dies, it's going to be subject to gift or estate tax with respect to the grantor. And so the advantage of that buildup would disappear. Now, oftentimes we say when we're expecting a gift tax audit, or there might be one, or we are using a defined value clause or something, we're making a gift of something, but the IRS could challenge it, and a subsequent settlement, maybe years later with the IRS or a court decision could determine that we really didn't transfer that much after all. Do we want to have a whole lot of years of income tax to realign because we were wrong about the amount that had been transferred and who really is the partner or the LLC member to the extent of that adjustment that's agreed to on audit? We would make sure that the donee was a grantor trust so that no matter what happened, no matter how the gift tax was settled and the amount of the gift, the amount of the transfer was finally determined, the grantor is going to pay the income tax anyway, whether it's the grantors or the grantor trust. But that could not be used anymore to simplify income tax treatment, because as long as it's a grantor trust, you never have settled the transfer tax, because there will still be that transfer tax overhang until grantor trust status terminates. That's transfer tax. How about income tax? Well, the House Ways and Means Committee bill says, unless a trust is fully revocable, which doesn't help too much for transfer tax purposes anyway, if it is, grantor trust status would be ignored in determining whether a transfer is a taxable sale. Well, if grantor trusts have been the hinge on which a lot of our planning swings, I would say that this grantor trust status causing the grantor to be treated as the owner and transactions with the trust being ignored has been the hinge on which the use of grantor trust swings. And of course, the authority there is Revenue Ruling 8513 that says grantor, being the owner, cannot have a transaction with themselves. So that means that there's no transaction, no sale. And that's how we get sales to grantor trusts and why they're effective. No more under this proposal if it passes. This would apply, unlike the transfer tax things on the last slide, this would apply to a deemed owned trust too. Now, here's an interesting thing. The committee report said, I'm sorry, we'll come to that. Section 267 disallows capital losses between related parties. That would be amended to disallow losses now between a grantor and the grantor trust as well. Examples now of how that would work. Sale by a grantor to a grantor trust, like I said, taxable to the extent of appreciation. Sale by a beneficiary to, say, a beat it. Yes, that's caught too under these income tax rules. That would be taxed. Exercise of a swap power, where one appreciated asset is substituted for another appreciated asset. That's an exchange. That would be a taxable exchange, and each party in that exchange would have gain recognized. Distribution in kind to a grantor. I use a 2020 grant as an example. Maybe it's a 2-year grant. That means in 2022, there's going to be the final distribution to the grantor. That's a monetary amount that the grantor is entitled to, but it's going to be satisfied with property in kind. That's the way grants typically work. And that satisfaction of a pecuniary obligation to a beneficiary with an appreciated asset in kind would be a taxable gain. Now, the effective date. Here's where it gets interesting. Both of these things we just looked at, the transfer tax alignment and the income tax, ignoring grantor trust status, would apply to trust created on or after the date of enactment. That's the date the president signs it. Or a portion of a trust attributable to a contribution on or after the date of enactment. So if after the date of enactment, a $9 million trust receives a $1 million contribution from the grantor, then that's 10% of it. I assume going forward, 10% of that trust would be subject to these rules. The committee report says one more very interesting thing. The portion of the provision relating to sales and exchanges, the last slide, not the one before it, is intended to be effective for sales or other dispositions after the date of enactment, period. It says nothing about trust created or funded or a portion of trust attributable to contribution on or after the date of enactment, only to sales or dispositions after the date of enactment. That is, regardless of when the trust was created or funded. A big deal. A footnote acknowledges a technical correction may be necessary to reflect this intent. What does that tell you? Well, it says may, it says technical, but it says necessary. That means they're not there yet. How are they going to get this technical correction? Maybe because it's only in the Ways and Means Committee, they're going to find a way to do it before the House votes? Not likely. How about in the Senate? The Senate will have a different idea of what to include in this Reconciliation Act. Might they, when they make their other changes, also make this technical correction? Sure. Frankly, I have never seen a technical correction referred to, except after the bill has been enacted and we know it's too late. For example, in the Tax Reform Act of 1986, the 2% floor on miscellaneous itemized deductions was described by the Joint Committee staff as intending that it not apply to deductions under sections 642C, 651, and 661 for a trust or estate, but a technical correction may be necessary. Well, in 1988, we got that technical correction 2 years later. Again, with respect to the GST tax that was enacted at the same time, the explanation said Congress intended that it would not apply to transfers made pursuant to revocable trust created before the date of enactment, October 2nd, 1986, if the grantor died before January 1st, 1987. A technical amendment may be necessary to achieve that. And that technical amendment didn't come till 1988 either. So in the meantime, we have this encouraging promise. And the IRS recognized that it was probably going to forbear from ignoring what was obviously congressional intent. And then we finally got the technical correction in there. That clears it up. Everybody is happy because the change is so welcome. This, though, is a different kind of technical correction. This technical correction is going to make it harsher, going to make it tougher. I've never seen such a thing before, and I don't know how that'll work. One more thing while we're on this slide. What's a contribution? Because if you have a pre-existing trust and a contribution is made to it, well, I gave you an example of the grantor adding $1 million to a $9 million trust. Of course. How about a swap of assets, exchange of assets? That is not a contribution as we know it, even though it would be subject to income tax. That should not make that, if it were a contribution, it shouldn't be a contribution because it doesn't increase the value of the trust. But we don't know. We just don't know. How about paying off a note? Same thing. That doesn't change the value, but that could be viewed as a contribution. How about paying income tax? Because it's a grantor trust. This is more like a contribution than anything, but because it's the grantor's own obligation. For decades now, the IRS has said that's not a gift because it's a payment of the grantor's own obligation. Even though it increases the value of someone else's trust, it is not a gift. Maybe we'll have the same result for the payment of tax. It's not a contribution if it's not a gift. We just don't know what contribution means. It's an odd term to use. While we're at it, the last two slides, grantor trust provisions, the transfer tax and income tax together is estimated over 10 years to raise $8 billion. $8 billion is a lot of money, but compare it to the numbers we talked about a few slides ago, totaling $750 billion. This is puny. If the House or the Senate or some combination get frustrated with this Grantor Trust set of rules, maybe because constituents have complained about it, are they going to fight hard to keep it in the bill for just $8 billion? I don't know. Does that mean for sure it's going to be dropped? Of course it doesn't. I don't know that either. Another provision, value of interest in entities. Again, when you see entities, think bullseye. The IRS has been after them. This would provide something that echoes what we saw in the Clinton administration and before that in the Reagan administration. Let's call it bipartisan then. A look-through rule for valuing non-business assets in an entity as if those assets had been transferred directly. Goodbye to entity-based minority, lack of control, or lack of marketability discounts. And then it goes on to say, and no valuation discount shall be allowed. Well, I thought that's what it meant, but it just says it again in case we didn't get it. And the interest itself will be valued in the usual way with discounts without regard to those non-business assets. So if we're talking about a business entity, then the business part of it is going to be valued in the usual way with entity level valuation discounts. Okay, so far so good on that front. It applies to gifts and deaths after the date of enactment. The entity is pre-existing, that doesn't matter. Applies to gifts and deaths after the date of enactment. Does not apply if the interest is actively traded. That's a relief. If I own General Motors stock, I don't have to inquire to see whether GM owns some non-business vacant land or something because it's actively traded. There are exceptions for assets used in the business, of course, or as reasonably required working capital, which could be cash. Cash is not really a business asset, it's passive, but it could be working capital. That is admittedly complex. I say admittedly because there's a lot of attention given in the proposal to the authority Treasury will have to write the regulations, because Congress, you see, is just not up to it because they don't know how to define all these things and divide the lines. It's going to be complicated. Passive assets not held for the production or collection of income. Really? So maybe a vacation home that's not rented out, there still be entity level discounts? That's a surprise. I just don't know. And the estimated 10-year revenue effect of this valuation provision is $20 billion. Already 2.5 times all that complex Grantor Trust stuff we saw. Now, here's something funny. This is a consolation. This is great news. This is a break. It's actually going to lose money for the IRS. It's a windfall for us, right? Well, let's see. Section 2032A, enacted in 1981, allows the estate tax value of real property that's used in a family farm or other family business. So you family farm owners, you family business owners out there, relax. We've got your back. That real property can be valued at that use in the business, even if that is not the highest and best use. Many, many technical tests about the definition of family. There has to be material participation, not necessarily by the owner we're talking about, the decedent we're talking about, but in the family, continuity, 5 of the last 8 years. There's a test about the share of the adjusted gross estate. At least half of it has to be business. That business, at least 25% of it, the business real estate. This applies only to real estate and so forth, and other rules. And plus there's recapture within 10 years because Congress said in the committee report, we don't want people to get a windfall. We want them to be serious about investing in a family farm or other family business. Okay, hold that thought about windfalls. Does not reduce the tax on the family farm or family business as such. It just does not. It doesn't say that. I'm saying that. All it does is prevent A bonus estate tax, which I submit is a windfall for the IRS. A bonus additional estate tax payable on the prospect of development. If the farm is in the path of development, for example, or speculation about development, it prevents the IRS from taxing more than the farm or business. It does not reduce the estate tax on the farm or business as such by $1. So great. That limit, which is now a little over $1 million, is going to be increased almost tenfold. It's going to be made ironically equal to today's basic exclusion amount. So the family business owners and family farmers should be mollified by that. I don't think so. It's estimated to lose $317 million. It's hard to say million, with all the other bigger numbers flying around. That's about 3.17 million of tax year. You divide by the estate tax rate of 0.4, that's about $80 million a year in less value that escapes tax. And if estates are using that maximum of 11.7, why, this is 7 or 8 estates a year are going to benefit from that. And as I say, not benefit, just prevent the IRS from getting found money as a benefit by taxing a farm that happens to be in the path of appreciation. But that farm up north or out east of y'all that is just out by itself and not in the path of development, that doesn't get any benefit from this at all, probably. Now, there are deemed realization proposals, which would be the next subject I would turn to. But first, on this House bill that we just went over, I wonder, David, have you seen questions? Have people asked questions, or is now maybe an opportunity to give a chance for questions?
That's a great question, Ron. And while we figure out how to exactly accomplish that technically for the people who are remote, does anybody who is in the physical room with us today have any questions at this moment where we can get Ron to opine? Questions, fact patterns, things you've heard? Okay, rumors. Any questions or comments on the Zoom, Brandon? Okay. Well, it's actually a great time just to remind the audience virtually that if you do have any questions or comments for Ron, go ahead and type it into the comment bar at the bottom of your Zoom portal, and we'll be sure to answer those at the right time. Ron, you are good to go back.
Okay, great. And there will be opportunity for questions later on. I will, as exciting as this stuff is, I will really try to pause. Deemed realization proposal, that we had a little sample of this in the House with Representative Pascal, New Jersey, introducing a bill. In the Senate with Senator Van Hollen of Maryland and some of his colleagues circulating a discussion draft. But the serious deemed realization proposal, and I would have told you a month ago would be what we'd be talking about today, first, was in the general explanations of the administration's fiscal year 2020 revenue proposals, commonly called Green Book, because before it went virtual, its cover was green. And in May, we saw that it elaborated this realization proposal that we had heard from the Obama-Biden administration in its Green Books, we had heard from Vice President Biden's campaign, and we heard it again after he became president. Effective January 1st, next year. No fresh start basis, though. In 1976, we had just carryover basis, not deemed realization, just carryover basis. It didn't last very long because it wasn't very popular and didn't seem to be very practical. But even for fresh start basis, we had a new basis as of December 31st, 1976. Either you look at the market on that day or you look at your holding period and you day by day prorate the appreciation so that only post 76 appreciation on that basis would be taxed. The gain that's realized at death or upon gifts is the fair market value minus basis. The proposal says there's no statutory language, just a discussion in the Green Book that it would be the property would be valued using the methodologies used for gift or estate tax purposes. Now, ignoring for a moment the fact that methodologies is used incorrectly in that structure. This sounds like the sort of thing that we will be doing for gift or estate tax purposes at the time of a gift or a death anyway. But it says a partial interest would be its proportional share of the fair market value of the entire property. Well, is that just an undivided interest in real estate, for example? Or is that an interest in an entity? Are we back to that again? And by the way, this doesn't say non-business. This would be non-business or business would be subject to this proportional share, kind of a look-through rule again. Losses at death would be allowed to offset gains, plus $3,000 of ordinary income, which is now the rule for annual calculation of income tax under Section 1211. I assume that if losses are going to offset death or offset gains at death, then that means that there will be an amendment to Section 267, like those House and Senate versions that I mentioned have, but this doesn't mention. I assume they have to do it anyway to relax the related party prohibition on recognition of losses and deduction of losses, because when a gift is made or a bequest occurs at death, typically, normally that's between related persons, of course. It would be reported on a gift or estate tax return or a separate capital gains return. Okay, fine. Whatever that means, the big question for us is whether the income tax would be deductible for estate tax purposes, not gift tax purposes. That's a bridge too far, but for estate tax purposes, it confirms that it would. And by the way, this is a new line on this slide that's not on the slide you have. I just added this morning because it's important. The Green Book proposal would also make the capital gains rate 39.6 for adjusted gross incomes over $1 million. As we saw several slides ago at the very beginning, that 39.6 has now, at least for the Ways and Means Committee, become 25%. Oh, well, but if we follow the Green Book math, the rate on the appreciation, making the 39.6% tax deductible, the combined rate, income tax and estate tax on the appreciation at death would be 63.76%. Everybody is wringing their hands and wincing over that one, but let me remind you that in 1982, the top estate tax rate was 65%. So it's all kind of relative. We've been there before, but it sometimes doesn't feel like it. Let me illustrate. We have Gen 1 investing $10,000, and by the time Gen 1 dies, it's gone up in value tenfold. It's $100,000. The estate tax today, assuming for all of these purposes that we've gone through all the exemptions and deductions, and we're at the top of all of that, the estate tax is $40,000. Under the Green Book proposal, there would be a 39.6% income tax on the $90,000 of gain and a 40% estate tax on $100,000 of value minus $35,640 of income tax for a combined rate of 61.4, a little bit less than what I told you on the previous slide, because it'll still be 63.76 for the gain part of that, the green part in this slide. Suppose Gen 2 then sells it for $200,000, $100,000 of gain. Today, there's a 20% income tax. Under the Green Book, there'd be a 39.6% income tax on that 100,000. Those calculations are easy, but then if Gen 2 didn't sell it but died with it today, 200,000 times 40% is 80,000 of estate tax. Under the Green Book, another 100,000 gain gets taxed at $39,600. That's deductible, and we have 64,160 left of estate tax, total of a little over 51.9, $103,760. Now, I want you to notice what has happened here. When the Gen 1 sells in that hypothetical example, the $39,600 has to be paid or owed. By the Gen 2's death, it is gone. It is not in the estate. So the estate tax, assuming no other changes in value, of course, for simplification, is still going to be $64,160 at a 40% rate. And this similarity in results, whether it is sold during life or held till death, is, as the Green Book says, intended to eliminate the lock-in effect that, to some people, distorts market decisions and distorts the economy by distorting those decisions, by making people artificially hold on to assets until they die just to get a stepped up basis. That's the argument. Folks, I'm going to give you some advocacy pieces here, not because I'm advocating, but just so that we know what's out there. The Green Book also goes on to say this would just be fairer because it would tax capital more like wages, 39.6% indeed. Well, is that a good idea? Why should capital get a break? Well, some would say the investor in capital takes a risk. The wage earner is going to get paid. I know there's bankruptcy and so forth, but they still usually try to protect wage earners. Wage earner is not gambling anything, risking loss of a paycheck at the end of the week or the month. But the investor is. The investor could lose. And taking risks is what builds the economy. And by the way, successful investments is what increases productivity, which improves the wages, at least the real wages of that wage earner who already shares in the benefit of the investor's risk taking. So shouldn't the risk taker get some benefit then, like a lower tax rate? Well, then somebody says, but look, there's an upside too that comes with that risk. Of course, it's a risk, but all the investor can lose is 100%. Some investors make thousands of percent over and above their initial investment. Now, I realize wage earners can get bonuses, but normally not bonuses of thousands of a percent of their wages. But the investor can. Is that fair? So it goes back and forth. This is not simple. This is not binary. This is not linear. There are many sides to this argument, but there's an illustration of it. There are exclusions from the deemed realization under the Green Book. For example, tangible personal property. This is a pretty puny exclusion because except for collectibles, they're not going to be sold at a gain anyway. Transfers by a decedent to a U.S. spouse. Probably equating to the estate tax, this is a citizen. It doesn't say that though, just an odd term, one more thing to clutter up our thinking about this. Transfers to charity, but I remember last May when this came out, there was a lot of drama in the charitable community about the fact that in the case of a split interest trust, it would be based only on the charity share of the value transfer, sort of like the charitable deduction. I don't know if that would work out good or bad because I don't know how it would work out at all. There would be a unified unified exclusion of $1 million of gain. What part of that $1 million is not used for lifetime gifts that have appreciated assets would be available at death. And it would be indexed for inflation. And it would be, it says, portable to the decedent's surviving spouse. Okay, how does that work? Portable, there's no decedent, there's no survivor. in the case of a gift. And remember, this applies to gifts. But I assume something like a gift splitting or the equivalent of it, or maybe targeted selective gift splitting is what is meant. The $250,000 exemption for personal residence, for principal residences would be allowed, except it would be expanded to apply to all residences, and it too would be portable. Again, during life, how does portability work? Well, for joint return, for example, between spouses, Section 121 already doubles that exclusion. Maybe it's something like that. Here we are, trust and estates again. Don't you just love it? The targets, the bullseyes. For a grantor trust that's deemed wholly owned and revocable. Now, if it's revocable, gain is taxed to the deemed owner on any asset distributed, just as if it was distributed by the owner himself or herself, unless it's made to the spouse or in discharge of an obligation, and all assets at the deemed owner's death or at any other time the trust becomes irrevocable. A little like we saw a few slides ago about the House Ways and Means Committee. And for other trusts, gain will be taxed when there's a transfer into the trust, a distribution in kind from the trust, and beginning in 2030, this actually is effective 1940, as you'll see. It's for any asset that's been held since 1940 or 1941 for the last 90 years without a gain recognition event, there'll be a mark to market. And this provision is the one of all the things we've discussed that looks like it could be the subject of a successful constitutional challenge, because there's no recognition event or realization event, or arguably one. More targeted relief provisions. Isn't this great that they've identified family farms and family businesses again? And if it was family owned and operated, the tax would not be due until the interest is sold or the business ceases to be family owned and operated. Folks, this is a lot more simple, direct, understandable, practical, comprehensive, and beneficial than Section 6166, which we now have for estate tax purposes. Only if we meet certain qualifications and certain limits, and we have only a 14-year period, and we have tax that's paid. It looks like there won't even be any tax due, because the tax isn't due until maybe generations later, when it is sold or the business ceases to be family owned and operated. Meanwhile, though, there would be a carryover basis suggesting that there's still a penalty down the road because there's more appreciation, because it's accumulated over more than one generation, perhaps. What's more, if something is not a family owned or operated business, but still is not liquid, marketable, then there's a 15-year fixed payment plan that kind of resembles 6166. Again, applicable to a whole lot more assets and without presumably the qualification percentages and so forth, but with interest. And the IRS would be authorized to require reasonable security at any time. Okay, great news for family farms and businesses, this one, isn't it? Because they won't have to pay any tax for all this time. Well, modify that, walk that back a little bit, because like I said, now the buildup, generations of generations without that step up in basis every generation is going to be a serious burden. What's more, the security, the liens are going to still hang over the head of this family owned and operated business and could impede the ability of the family business to raise capital while it is facing this due date at some uncertain time in the future. This is different from, for example, the shareholder of a publicly traded corporation. Upon death, that stock can be sold. The corporation is not hurt at all. Family farms and family businesses, in contrast, often bear a portion, at least, of the estate tax burden, and that is unfair from a standpoint of competition in contrast to that publicly owned competitor. Congress has acknowledged this, and yet the things it has done to protect family farms and family owned and operated businesses have not always been that effective. There's going to be a lot of administrative provisions. Full cost of appraisals are going to be deductible. Well, that's a relief. We hope so. Liens, again, are mentioned. Waiver of penalties if when a person dies, they have not paid enough estimated tax to anticipate the gains at death. Of course, they need to get relief from that. They didn't plan to die typically. Right of recovery of tax on unrealized gains, rules to determine who selects the return to be filed. Not sure what either of those two really mean. And broad regulatory authority, including rules and safe harbors for determining the basis of assets in cases where complete records are unavailable. Remember, I said no fresh start like there was in 1976. No new basis like Treasury in its proposals in the 1960s about realization of death included. And I think in acknowledgement of that, and that it is probably easier now to know historically what cost basis is in the digital age, still not a slam dunk. And recognizing that difficulty, I would expect Treasury to take this as a cue to be very lenient in its regulations. Revenue estimates. The increased rate on capital gains to 39.6 and this proposal about deemed realization, death, and upon gifts together have been scored, as the Joint Committee staff calls it, at about $322.5 billion over the next 10 fiscal years, including a real odd $1.25 billion for the fiscal year that ended last week. Like people would make some sales after April 28th, remember when this was thought to be effective, and then they would change their estimated reporting because, you know, the IRS hasn't gotten any 2021 tax returns yet or any tax paid in its 2021 fiscal year. So I don't know what that means. It is just a mystery. And it's one of these things that shows how quickly some of this has gotten thrown together. Meanwhile, as I mentioned, there were congressional rumblings early. In March, we had the deemed realization proposals in Congress that I mentioned, both in the House, Representative Bill Pascrell, member of the Ways and Means Committee, and I believe his bill shows a little more staff input and probably was the bill to watch. But the tax press and most of my colleagues picked on Senator Van Hollen's to be the one to talk about the most. There were some differences from the Green Book proposal. The test, as we saw, was includability in the estate, not revocability. Appreciation in other trusts not deemed owned is going to be taxed every 30 years, every 21 years in those proposals. We have 90 in the Green Book, very broad annual reporting, almost like a probate court account in the STEP Act. No mention of partnerships, by the way, which you may have noticed was slipped into one of the earlier slides. And I don't know what at all it means to apply these rules to partnerships. Turn section 704 and 734 and all those other complex basis adjustment provisions completely on their head and do it under the guise of amending the rules for trusts. And Van Hollen's discussion draft, which attracted a lot of attention, would have been retroactive. I don't think the staff would have viewed that as the norm going forward. There are other bills that we've seen in Congress. We don't have to say too much about Senator Sanders' bill. I have already made the references to it that I need, and you will see in his bill and on pages 2 to 7 of the material that I think you have or are going to have. Most of these slides have page numbers to the more detailed discussion in that material. I just noticed, for example, that he would increase the special use valuation too. Oh my, what a big deal. Would provide for look-through value. and would conform the gift and estate tax treatment to Grantor Trusts, some of the things we've already talked about. And then one last topic before I take that promised pause to see if there are questions. In every Congress for decades, we've had a proposal to completely and permanently repeal the estate tax. The House passed such a bill a couple of times, including once in the Clinton administration and once in the Obama administration. In 2001, the House and Senate both totally repealed the estate tax, but not permanently, as you know, because in 2010, it just came back. And the thing, though, that I want you to see is what I've highlighted here. I mean, can anybody look at this slide and guess what I meant to emphasize? These bills consistently over the decades to totally and permanently repeal the estate tax and okay, the GST tax will retain the gift tax. Now, why is that? We heard around 2001 some talk about how, well, you need the gift tax to protect the income tax. That has never been true historically. Gift tax has always been viewed as a backup to the estate tax. So if you repeal the estate tax, why do you need the gift tax as a backup? Well, I believe, again, it's a guess, but we've had several decades now to kind of track and guess that there are staff members who understand that to repeal the estate tax, you have to retain the gift tax, because if the estate tax is repealed now, you know how politics is, things change. Another Congress could reinstate the estate tax later. And if we're going to reinstate the estate tax later, we have to have a gift tax in the meantime to make sure that those estates are still around to tax. It, I believe, is as simple as that. So watch for it. But that identifies a good theme for this entire presentation. That is that everything is unpredictable, everything is unstable, everything in this political environment is complicated and not durable. So I am prepared to pause again and see if now we have some questions. I have more. I could go on, but I was going to turn to administrative matters, which aren't nearly quite as interesting. So we could take as many as much time as you all
Ron,
wish.
one of our members here in the Ron, we have one question from the audience here. One of our more sophisticated planners wants to know what your thoughts are on the chances of the Grantor Trust provisions actually passing, and should they start advising clients to do slats as soon as possible?
The chances of it passing, as we will someday know, is either 100 or 0. Now, you're looking for something in between. And so I could tell you 40, I could tell you 60. I might not go too much lower or higher than that, because really I want to let you know that I don't know and nobody knows. And what difference would it make? If I told you 2%, you couldn't rely on that and shouldn't. But what I do know is that, you know, if there was stuff that people were thinking about that's underway that makes sense for them, a client has been sitting on drafts for 3 years, but it's a good thing to do, and it still is, then do it now rather than wait. Seems like a good idea. But any other thing to do in adaptation to a law that hasn't been enacted yet runs the risk of just overreacting, and then you're stuck with the consequences, or the client isn't that. So it's very hard to know, particularly in a generic way, client by client, of course, after explaining risks and evaluating all the pros and cons. There will be decisions that will be made, and there will be customized advice to clients to help them make that. But I think the only input regarding the proposed legislation, whether it's the Green Book stuff that could get picked up in the Senate or the House Ways and Means stuff, which we already see being considered in the House, or whether the question is whether a Reconciliation Act can be passed at all. Either way, I just have to say, I don't know. And if we're somewhere between a third and 2/3 or somewhere between 40 and 60, you're going to get the idea.
All right, we have another question. It says, will a contribution made by someone other than the trustor or grantor or a grantor trust cause any estate tax inclusion? Also, if the trustor's estate plan includes a pour over into the trustor's IDGT at the trustor's death, is there any adverse consequences when the pour over property is already in the trustor's estate?
Well, that's a little easier as a technical matter to evaluate on the basis of what we know. What the Ways and Means Committee has passed, you may recall, with regard to grantor trusts and the transfer tax alignment does not apply to deemed owners. So I would think that for purposes of the transfer tax changes, a contribution from someone else would not affect what we might call the grandfathered status of that trust for purposes of the conformity to gift tax on termination or gift, estate tax on death. But the income tax rules that would provide that there's realization of gain also include deemed owners. If the person who makes that contribution, who's not the grantor, becomes a deemed owner to that extent, then I would say possibly yes, to that extent. Is there a way that a completely no strings attached donation into this trust from someone else other than the grantor or the grantor's spouse would have an effect on the grandfathered status or the effective date provisions? That looks really, really difficult to expect, and I do not expect that. And remember, then if there are no contributions, that trust would be grandfathered for purposes of the alignment with the transfer tax. Now, there was also a second part to this question, and maybe to help the audience, and by the way, also help me, you could repeat what that was.
I wish I could, but the question is no longer there.
Okay, well, it was a contribution from the estate into what had been a defective grantor trust during life. Yes, I think that would be a contribution. But by that time, grantor trust status ceases because the grantor has died. So we would probably measure that by the rules for just taxing that at death, if we ever have those rules, the deemed realization. So it's complicated because it's kind of cross-disciplinary. The one question relates to the House Ways and Means proposal, the other to the Green Book proposal, and I'm not sure in what form we will see that yet. I would not be positive that even though I don't see a way that contribution at death would have an effect under the current statutory language, that by the time this makes it through Congress, if it does, somebody in Congress hasn't figured out a way to make it a problem after all. Sorry.
And I have another question that just came in to ask about possible changes to SEC 1031.
I don't know.
All right. I'm going to hand the microphone over to Mark. He has another question.
Oh, yeah, that was the one before. But I do have a question with regard, I'm forecasting a little bit further ahead with the, do you think the dropping the step up in basis for grantor trusts from the priority guidance, do you think that will have a, that in RepRoc 2022-3, when they come out, will they drop the no rule policy as well, since they've dropped it from their priority guidance?
Well, we could go on another hour through the priority guidance plan, probably not an hour, but we're not going to. And you have the slides, and slide 39 is about this, what's been omitted. And that's one of those things that it seems as the background in the written material will show, at least from my perspective, that the only reason we had that was to deal with foreign trusts that are not included in a gross estate, because they're just not, because the foreigner is not subject to estate tax. So the test is whether they would be included in the gross estate if the foreign grantor were a US citizen or a US resident, and then would the assets be stepped up as if they had been included in the gross estate. The answer the IRS was probably moving toward was yes. I never thought that this was a proposal to subject or to give a stepped up basis to, in the ordinary case of a US person who creates a grantor trust that's excluded from the gross estate, because there's been no inclusion in the estate to, as it were, compensate. I know that I am not alone in that view. I also know there have been contrary views expressed. I do not agree and have never agreed with those contrary views. So I thought that this was a very tiny proposal. In any event, a kind of a yawn for us, even if it had been retained on the priority guidance plan. It still might come back if need be, but you're absolutely right that with everything else that's going on, it was time for Treasury to just step back and say, we're not going to write regs that may end up being a fool's errand because the statute could change so dramatically.
All right, we have another question. It says, where the house is transferred to the children through a QPRT, which is a grantor trust, is the rent that the parent is paying to the QPRT in addition to a grantor trust?
Okay, this QPRT or QPERT, it's pronounced different ways. The term for which the grantor has used the property rent-free, the QPERT term, has now ended. The property is still in trust. It's still a grantor trust because of other reasons, and the grantor is paying rent. Oh my, what a question. We have seen in these proposals, particularly the House bill, a really, really determined crackdown on this notion that the grantor and the grantor trust relationship are ignored. So the grantor is taxed on transactions with the trust, but only sales, only transfers of property, maybe like-kind exchanges. Not rent, not interest, possibly not even that income tax that the grantor pays on the trust's income because it's a grantor trust. The only focus was on sales, because don't you know, our technique is sales to an intentionally defective grantor trust. That's the technique. Whoever says, I'm going to recommend to my client that they pay rent to a grantor trust. No, it's always about the sale. And the sale is the target. The rent is not. I think the answer to the question is that under the provisions we've seen written in statutory language and summarized so far, the rent is not caught.
All right, thank you. May I hand the microphone back to Bill?
Thanks, Ron, so very much for all your insights on what may happen or not. Can't put you on the spot, but thank you so very much for all the insights and, of course, the beautiful outlines and PowerPoints. Thank you all for attending the first in-person meeting. Thank you. Thanks to the Zoom folks for attending. Hello, Ellen. Glad that you could make it. Certainly remember our October 28th social event, which is going to be right here from 4 to 7:30. And then our first Tuesday of the month in November, our meeting on deferred compensation, which will actually be a great presentation kind of covering not only the mechanics of the planning, but the reasons behind it. So thanks so much, and we will see you soon. Bye-bye.
I wasn't coming in today.